Hello everyone and welcome back to Accounting for Noob. Now that have mastered the periodic adjustment for depreciation, today we are going to explore the final stage of an asset's life, which is how to record the disposal of non-current assets after they have served the business for several years. Let's begin by reviewing the initial acquisition of the asset into our accounting record. When we first purchased the non-current asset, we recorded the cost as a capital expenditure in our financial statement. Consequently, when the time comes to sell that asset, the proceeds we receive are classified as capital received, marking the final stage in the disposal of non-current asset. How to record purchase of non-current asset? If you acquired the asset using cash or bank payment, the initial journal entry involved a debit to non-current asset account and credit to the bank account, which was then posted to the ledger. However, if the asset was purchased on credit, you simply replace the bank with the trade payable, specifically the other payable for the asset supplier. The process of transferring this into the ledger remains exactly the same as a cash transaction. How to record depreciation of non-current asset? As we use the asset over time, its value decreases, and a process known as depreciation. To record this decrease in value, we must use the following entries. Debit depreciation of non-current asset to record the expenses for the year. Credit the provision for depreciation of non-current asset to record the total accumulated depreciation to date. Once this entry was posted into ledger, we have clear record the asset net book value. The net book value is equal to the cost minus accumulated depreciation. How to record disposal of non-current asset? Now we reach the critical moment. The asset has been used, depreciated, and we are ready to sell it. To record the sales correctly, we must remove the asset from our book. We do this by transferring the original cost of the asset from non-current asset account into new temporary account called the disposal account. This brings the balance of the non-current asset account to zero. But we aren't finished yet. We also need to zero out the provision for depreciation account. We transfer the total accumulated depreciation relating specifically to that asset into the disposal account. By following this step, our book remains tidy and we can clearly see if our disposal result is profit or a loss for the business. Now that we have transferred both the original cost and the accumulated depreciation into disposal account, it is time for the final chapter, recording the value we receive for the asset. When we sell the asset and receive a check, we recorded this process by debiting the bank account and crediting the disposal account. This is reflect the capital received entering the business. At the end of financial year, we must close the disposal account. If the total debit and total credit do not balance, we use the filler entry to bring account to zero. This balance is transferred directly into income statement. Pay close attention here, as this is a favorite for examiner. If the transfer to the income statement is on credit side, of the disposal account, the business has incurred a loss on disposal. But if the transfer is on debit side, the business has made gain on disposal. Sometimes the process changes slightly if we decided to trade in or exchange our old asset for a new one. In this scenario, we don't receive a physical cash and instead we receive a part exchange allowance toward a new non-current asset. To record a part exchange, we debit a new non-current asset account and credit the disposal account with the value of the allowance. If a new asset is more expensive, then we must pay extra. We also credit the bank account for the additional amount. At the end of the year, we have to do this process. Regardless of whether we receive cash or part exchange, the year-end process remains the same. We balance the account and transfer the resulting gain or loss into income statement.